Hello, everyone. Welcome back to Zer0es TV. It's been an incredible year in 2021, and I'm joined today by Freddy and Carson of Muddy Waters Capital to go over that year for markets and for Zer0es. Gentlemen, thank you both for being here. Well, on top of it being that incredible year, it's also a year where I think we all feel lucky to even be here. So Carson, Freddy, I'm glad to see that you made it through 2021 alive.
Glad to have made it through alive, although there are still a few days left. So, hopefully this isn't one of those ironic statements.
Yeah, fingers crossed. Well, Zer0es TV is going to be here at the end of the year. That is for certain. And we're looking forward to another great year in 2022. But let's examine some of the stuff that we have been doing this year and really, what the market has provided us in terms of incredible fodder.
As a short seller, I mean, the year started off basically with people calling us, asking whether we're going to still be in business. And it's ended reasonably well. I mean, certainly for activist short sellers, it's been I think a great year for some activist short sellers. And it's interesting because there's this dichotomy here at the end of the year where the non-activist short sellers, so long short investors, there have been some who have been in the headlines very notably saying that they're not going to be pursuing short selling strategies anymore. And then again, you look around at the activist short sellers, at least since February, since Hindenburg published on Clover Health, have had really good years. So I don't know if we've seen such a divergence there in the past.
Yeah, and I think our friend at Breakout Point, Ivan Chosevich, has done a great job of tracking all of the reports this year. And the numbers are pretty staggering if you go across, I think it was over 150 different major reports that have come out this year. And the average stock has had a substantially negative return that short sellers have targeted. But what you're highlighting there is a little bit the difference between the destination and the path. So in short selling, it doesn't matter whether the stock ends up down 80% at the end of the day. If it spikes up 100 a couple times in between there, you can get hurt pretty badly. And I think that as well is one of the stories of this year. It's really easy to look at the short candidates and say, well, they're all down, but it has been a bumpy road getting there.
Yeah, definitely. Although I think this is a good opportunity to do a plug for Zer0es because the performance of names that have been first mentioned on the chopping block has been pretty good. So I think we've got about 80% of stocks are down over the long term. Is that right, Max?
Yeah, so I keep track of all the data and I do kind of a 1 day, a 1 week, month, 3 month, 6 month, and then just as of the last weekly close. And I keep tracking them. So some of the ideas in that final data point, the last weekly close, is what you're talking about. Some of them are more shorter term, like we just had the co-holdings piece. That's included in it. So it counts in the long-term data, but it's really still in the short-term point of its life cycle. But when you go out and you start taking them, there were 13 ideas that came out this year. And I think the hit rate was over 80%. In terms of stocks that are down, and the average return was around negative 30% from there. And what you see actually, if you go over that short-term data as well as the long-term data, is pretty strong hit rate in the early days. You get the squeezing, you get the bouncing, technical bounces that happen, which you guys talked about in that video, really about where you really opened up the curtain on how the activist short selling business works. You get those technical bounces, but then from there, over time, it's kind of proving that activist short sellers do, at the very least, tend to target companies that have problems, whether the market initially believes that report or not. Over the long run, they do seem to find their way moving down. Freddy, we haven't gotten a word from you. How are you characterizing the year in 2021?
It started with me in my office at home. Based on Omicron, it looks like it's going to end the year with me in my office at home. So it's just the same flavor of a different tonic. But look, going back to what you discussed in terms of performance and activist short selling, the randomness in outcomes over short periods of time is something that I think from probably March of 2020 onwards has continued to dominate in markets. And as you discussed, like the pathway to a lower stock price or zero has become increasingly volatile. But it does give me real comfort to see, some of our campaigns and a lot of other activist short sellers really being able to identify where the alpha is on the short side. And while, we continue to get questions from people, why do you do this? Are you insane? Are you aware that a stock can only go down 100% and can go up 6,000% in a matter of days and weeks? I think they're probably measured by aggregate dollars more alpha on the short side than there maybe has ever been in markets. And even names that are down 30, 40, 60, 70% from their highs continue to provide significant alpha. And with the distortion we've seen in markets, I'm actually really hopeful that 2022 is going to continue to be a really good year for activist short sellers. And in addition to that, with some of the smartest large investors on the planet throwing in the towel on individual short selling, if not short selling in general, as well as a switch for many active managers from shorting single names to shorting indexes, I think now more than ever, the activist short seller is something that's really beneficial for markets.
It's also good to think back to really 1 year ago, probably almost to the day. That's when I interviewed Andrew Left. And Andrew was saying that he thought 2021 would be a good year for short sellers.
Once you realized that this world was not coming to an end in March, okay, and we were going to survive differently, and things were oversold, it was not going to be a one-day reaction. Everyone had to readjust their money. Everyone, okay? When things do start coming in, and we do have a catalyst for it, whatever it is, okay? And those names, and what's happening right now, Carson, in my opinion, is that there's just more supply. I mean, they're bringing on so many SPACs, and everyone's doing secondaries and more IPOs. I mean, eventually, there's only a finite amount of money that can be used for speculative investments, okay? And that'll bring it down. Don't worry about guessing a top. Wait for it to happen, and then you can adjust.
And he specifically talked about how the supply of, codes is growing relative to the demand. Now, there's real irony there because 2021, the way it started with GameStop, knocked Andrew out of short selling as well, or at least that's what he says. But, I think that prediction has actually played out. I think Andrew's been correct. And it does make me wonder really whether these long short guys are reacting to noise as opposed to signal when they say that they're pulling their short strategies. Everybody talks when they do this, they talk about the meme stocks and gamification of markets. But, the meme stocks are relatively small portion of the overall universe. And you can see the meme stocks, becoming meme stocks through monitoring Wall Street Bets and other social media. So I don't know. I do wonder. I'm not complaining because I do prefer less crowded trades, but I do wonder whether this is, actually good decision by these firms to get out of doing individual shorts at this stage.
Well, you guys have LPs. I mean, how much of this do you think is being driven by the LPs as much as it is the managers themselves?
Well, I mean, our conversation with LPs is obviously very different from that of Tyborn because, we are activist short sellers and that's the strategy at this point. But so I don't know, what those conversations are like. But when we've been asked this question by our LPs, so if you rewind to late January, early February. That's when getting all these calls, are you going out of business? How do you survive this? And I did a lot of media at the time because it was sort of futile, it felt, to actually research stocks. And, I guess what I after I understood or, think I understood what happened there with GameStop, et cetera, is, my take is that you can see this building in terms of the potential squeezes. There was horrific risk management by by Melvin in the GameStop position. They were just clearly way too big. Now, maybe the answer is if you're one of these large long short funds, that the position sizing you have to put on makes you too big for a lot of these, for a lot of the short opportunities. But I think there's a good answer, which is we're paying attention to social media. We're not getting in stuff where there's a large short interest relative to the float. But yeah, as I said, I'm not going to complain here.
All right. Well, you talked about short interest relative to float. I think that's a great way to get into some of the conversations we've had here on Zer0es that didn't really break new ideas, but brought some new ideas to the market in a broader sense. And we had Mike Green on talking about passive investment and the way that passive is really coming to dominate a lot of the floats of these stocks.
So the analogy that I use for people is when you go into a market to trade, right? Imagine you've walked into a Moroccan souk, right? You have to find somebody who's actually willing to transact with you. And so the way to model this is to imagine that you reach into a bag and you pull out a marble, and there's black and white marbles in the bag. If you pull out a black marble, that represents a discretionary trader, and you can actually get them to consider whether they want to trade with you based on any number of criteria: slightly higher price, fundamentals have changed, the company just reported earnings, etc. Right? So you reach in, you pull out a black marble, you have the capacity to execute a trade. If you reach in and you pull a white marble out, you don't have the capacity to trade. That's a passive player. There is no condition under which they are going to trade with you unless they have received a signal from their end investor that says, I have given you cash or I have asked for cash. Right? Those are the only reasons why a passive vehicle will trade with you. So as you increase the proportion of white marbles in the bag, as passive gains share, you raise the odds that every time you reach in to try to execute a trade, you can't do so. And so when you want to reach, you effectively have to try again, right? So if you are trying to buy back a short, that means you raise your bid for the shares that you want to buy. You put your hand back in. If you pull out a white marble, a passive marble, they're not going to trade with you. Raise it again, put it in, right? Pull it back out. Is it a white marble? As passive becomes larger and larger, your probability of drawing out a white marble rises, and it creates these conditions that allow the squeeze to happen with increasing frequency and, equally important, increasing severity.
And actually, there was an article that came out from a UK publication with Reed from Wolfpack, where he was specifically citing this research and how it's affected the way he's calculating floats. So not only are we breaking new short theses here, but we're helping to bring new dynamics that are changing that people are implementing into short selling. I think that's a great example, but there's so much more. Was there anything in particular, Carson, Freddy, that you thought stood out as new ideas that you heard about on Zer0es TV that you're starting to see pick up elsewhere in the world?
So yeah, for me, one of the most interesting guests we had on this year was Tariq Fancy. Here's a guy who'd been very successful working his way within the system and basically took the decision to call bullshit on ESG.
But the worst part about it is that they're using one hand to delay taxes and regulation. And then in the growing social angst that's opening up in between, because people are like, what the hell are we doing on climate change? And look at inequality and spilling into the streets. They're using the other hand to sell a bunch of green crap, right? It's a whole bunch of products that, like all of these ESG ETFs, there's no measurable impact out of any of them, right? They can't measure a thing. And they're selling it clearly to people who believe that by buying it and paying 43% greater fees, they must be creating some impact that wouldn't have otherwise happened, when none of that's the case. And the worst part, all of that is being done under the guise of responsible business, right? And if you stop and think about it, you're kind of like, wait a second, like, if you have a CEO who's 68 or something, it's like clearly in their interest to do it, but it's not clear to me it's in their own employees' interests, right? If you're a 20 or 30 or 40-year-old at BlackRock, the longer we kick the can down the road on climate change, the worse it's going to be.
And how investment managers are using ESG to put a nice sticker on something to basically appeal to the millennial generation who've been somewhat chastened by traditional finance, and to find a way to basically make it look like, the world can be fuzzy, we can all do good, and I can charge you an extra 20 basis points on top of a passive tracker in order to do that. And the best part about that for me was not only that you had someone deeply knowledgeable who was explaining to people how it really worked, was actually exposing the fact that many fund managers who are kind of mandated to believe this and buy into it basically don't believe in it, and that the data doesn't really prove out that it generates significantly better returns. Because we'd all love to think that, we can do good and make great returns and that's win-win for everyone. But when you peel when you peel behind the veneer and you see that actually the two aren't related, and if anything, they're negatively correlated, I think that really leads us to question what we're doing in terms of tackling climate change, whether the investment industry is remotely equipped to tackle climate change, and if there are certain structures within the investment community that are actually doing significantly more damaging by, as kind of what Tariq likened to giving wheatgrass to a cancer patient.
The analogy I used was that ESG and sustainable investing and all these products were like giving wheatgrass to a cancer patient, right? The cancer is spreading. We've marketed this really well, but there's no impact out of any of it. And there's no reason to even believe that any of it would have any impact. And then I realized it's even worse, because you realize that the cancer patient is delaying chemo because we're aggressively selling this wheatgrass as the next big thing. And at that point, you realize that this is actually not harmless. It's actually probably harmful and will be remembered, years from now as this period of fantasies where, we told us there was win-win solutions where you can buy a low carbon ETF and fight climate change. And it distracted us from the fact that, like we've known for decades, it's obviously a carbon tax.
And delaying the hard decisions that need to be made to catalyze real change over the long term. So, I was really pleased that Carson, I think, had reached out to him and we were able to explore that in depth. And, I think Tariq's done a phenomenal job on other mediums, not only through his paper that he published, but some op-eds he did in the FT. So for people who haven't had a chance to really get into what Tariq is talking about, I'd strongly encourage them to go and read some of the materials that he's published over the last year.
And one thing I liked also, point that Tariq made, was that as far as corporates go, as well as the funds management or the investment industry, pushing this ESG can solve the problems narrative, or the market can correct itself narrative, is also effective at staving off regulation that is intended to address the problems and the excesses that are being produced by our system. But yeah, they can potentially just delay that for a while by spinning this myth that the market can correct itself through ESG investing.
Well, I think the analogy that I've heard that captured it best is sort of like the cigarette industry in the 50s and 60s. Like, the data had come in, they kind of knew, and then they started going out and saying, well, we're doing the research. We're working with you guys. We've got doctors. We want to get to the bottom of this issue ourselves, and to figure out, down the line, that really what you had to do was stop advertising to children. You had to put these labels on them. That it took years and years and years to do that. But there was a whole period where, the idea of the safer cigarette and there was all of this rhetoric coming. I think that is a really fantastic analogy for some of the things that we're seeing. Not all ESG. They're not cancer sticks, but at the same time, there are some interesting crossovers there. But ESG was one where, you're starting to hear people talk about it, but there's some where progress is actually being seen. My favorite example of that was Professor Dan Taylor from Wharton, and his research looking into how the 10b5-1 plans, the insider transaction plans for executives at corporations, and how they go about exercising their options and selling their stock.
I don't have private information at the time I enter the plan. Okay, so I'm giving the executive the benefit of the doubt. They enter the plan legitimately. This is all, legal right now, what I'm describing. So they say, okay, no problem. CEO Taylor signing off. All right, go to the first earnings announcement. It's going to be a loser. It's going to be a dud. I know that 5 days before the earnings announcement, 10 days, 20 days. So I let the trade execute. So I sell before bad news. And maybe the media covers it. maybe Muddy Waters writes a short report on it, and I say, nothing to see here, 10b5-1 plan. I put it in place, a while ago. But then next quarter, I learn, this isn't going to be a dud of an earnings announcement. This earnings announcement is going to be a good one. So I don't want to sell before the earnings announcement. I want to sell after the earnings announcement. So you know what I'm going to do? I'm going to cancel my plan. Now, turns out that that's not trading on possession of material non-public information, because I didn't trade. I did not trade based on material non-public information. And not trading on material non-public information under current guidance can be construed as legal. So you can set up these plans and then cancel them. And that's sort of one glaring red flaw, is that they can be canceled while you're in possession of material non-public information. Now, if the SEC can prove that you did that and that you do it repeatedly, you're going to be in legal jeopardy. But, this is where we get to some really perverse things about Rule 10b5-1. The SEC isn't going to know unless they subpoena your broker and get the plan, because the plans don't have to be disclosed. Your modifications don't have to be disclosed. Your cancellations don't have to be disclosed. The only thing that has to be disclosed is the trade. But you don't even have to tell the market that the trade was a 10b5-1 trade.
How, if you look at the data, it's very clear that it's being abused. Dan put out his paper, and we had him on Zer0es. I forget exactly when, but I swear that was really the first place I had seen it. And within a few days, you started to see some rumblings from the SEC. And as recently, I think just a few days ago, in mid-December, they put out a proposal to change those rules. So conversations that are happening on Zer0es are resulting in policy change.
And I got to say, I'm delighted to see how fast the SEC and a number of other organizations picked up on what Dan's been working on for a number of years. The thing that I find most interesting is one of the proposed changes, in addition to having kind of more of a blackout type window for executives, is they are proposing the need to disclose the reason for the stock sale. So I'm very, very excited to see the executive who's dumping $50 million of stock, who's going to be like, yeah, this one's for, building out another division in my vineyard, or it's, extending the Hamptons mansion for a bigger boat dock. My assumption is the rational reason will be like, because I can. But that could lead to some very, very interesting disclosures from executives. And going way back to my earlier days in Hong Kong, it reminds me of when a Li Feng executive sold a significant stake of stock. I think it was around a couple $100 million of stock that Bruce Rockowitz sold, and the market was looking for kind of a question as to why he was selling so much stock. And he mentioned that his daughter was getting married. So we might see more $200 million wedding disclosures, but I think it's really great that the work Dan has done. The SEC have obviously, it sounds like, been engaging with him and on taking this pretty abusive practice very seriously. No doubt there'll be investment banks working with executives to find new and innovative ways to get around these disclosures in short order. So the race between the drug cheats and the drug testers will likely continue, I'm sure.
So there's one piece in particular that I'd like to highlight that we did this year that I think really is the essence of what this channel is all about. And that was a piece that we did with you, Freddy, you, Carson, then as well, Dan David from Wolfpack Research, that was titled, Breaking Down the Business Model of Activist Short Selling.
Yeah, I think, look, three of us, we know the model well. Like, let's talk about it. When a short activist usually goes into an initiation or campaign initiation, if you're a pure short activist and you speak 5 times a year or 4 times a year, maybe a little bit more, that's very few chances to generate revenue. And I think obviously this number is going to be different for everybody, but if I assume that we, Muddy Waters, speak 5 times a year, if I'm allocating the hard costs of the research, the some sort of legal contingency, because we get sued like, I used to say every 2 years. I feel like it's maybe now more, once every 18 months. Thank you, Steven Sugarman, psycho. You allocate that, and then our internal costs on the research side. I mean, I feel like every time we speak, there's a cost of $500,000 to $600,000 that's gone into that. Now, you're not going to make money on every single one of these, and you sometimes lose money on these actually. So you have to kind of allocate that as well when you think about this. And then, we manage outside capital. Some portion of it is ours, vast majority is outside, and we get paid a fee. And so the $500,000-$600,000 cost is largely borne out of our pockets. It's not borne out of the investors' pockets. So when you get down to it, what we need is we need to make enough money off that to repay the cost, and hopefully actually make this worth the stress and the bullshit and all of the things that are attendant with this. So what does that mean? That means as a short activist, you normally get really, really big right before you go public, like so big that you could be put out of business if the company were to announce, hey, we're going to be acquired, 40% premium or something like that. Like you could be, and I think most of us in short activism have a substantial portion of our net worths on the line every single time this happens.
What you guys do is truly niche. It's niche even within people who short stocks, and so much is misunderstood. I think 2021 was the year that perfectly crystallized how misunderstood short selling was between the retail army, between people conflating what you guys do with what, the short only funds that are, for lack of a better word, passive do. It's pretty incredible. And that interview was really the most full on expose of how your business actually works. I know we can't go through all of it here, but I would love to get, a summary of what you think you guys do in your own words.
We try to put out stories that people care about that involve individual companies and highlight risks that or problems that are not known to the market. And we have to, this cost a lot of money to put out. We get sued not infrequently, so there's even more money that you have to make sure you're making so you can pay for defending those litigations. And yeah, we have to fund businesses and pay staffs. So basically, the way that activist short selling evolved was structured around this idea that you're only going to speak a few times a year, and you need to make sure that you're not losing significant money when you do, and then you have the opportunity to make significant money to pay for your costs as a business. So it's really, I think of it as a publishing business. I think of it as a news publishing business. And that's, our discussion really got into. How do you fund that? Previously, the model for funding investigative financial journalism was advertisers in papers. But, we know that budgets for investigative journalism, let alone investigative financial journalism, have been shrinking. So this is another model of funding it. And that's what we wanted to convey.
Well, you have the advertiser aspect to it, which is maybe advertisers aren't really too interested in funding investigative journalism that they could end up on the wrong side of. But on the other side, you just have the shrinking attention spans. That's one of the things the reasons that Zer0es is here is it's hard enough to get people to read one page, much less 50 pages with disclosures, with data, with research and all of that. And that's kind of what the chopping block is all about, is meeting the audience where they're at right now with video, with something that they can consume that's highly engaging for 20 minutes. So there's the business side of it too, but then there's the audience side of it. Freddie, I would love to get your take on that. I mean, is it harder to get people to read activist short selling research these days?
Without doubt, the shock factor from activist research is just not what it was when Carson started this business, because it's been somewhat more widely uptaken by a number of people who do really good work and run small funds or basically one-man operations. So, the sheer number of reports has increased, which is going to make the impact somewhat muted from an excitement standpoint. In addition to that, shorter attention spans, and I think everything has moved to video. We're not the only medium that has put out an increasing amount of video or podcast style content.
So what in the world is a SPAC anyway? Suppose a group of strangers came up to you and said, I have a company that doesn't do much of anything, but sometime in the next 2 years, we'll merge with another company. I don't know what that company is yet. Would you invest in the stranger's company? What if I told you that if the strangers complete a merger, they get to pocket 20% of your investment? That's essentially what a special purpose acquisition company, a SPAC, does.
So that's where the world's moving. And, I think part of what's really key to this remaining successful as a business model is that long-term alpha generation. So the outsourced research effectively is what we've become for a lot of fund managers. A lot of fund managers who might have one analyst working on the short side and several working on the long side frequently tell me, look, we don't need to spend time, money, and effort going through filings and pulling up stuff in the middle of nowhere or having investigators, because you guys are doing the work for us. And if we miss the first 10 or 15%, who really cares if long-term your calls are generating 50, 60% of alpha? And all we've got to do is verify what you're saying. It's like, free research of some of the highest quality that we're able to access. So from an investment industry standpoint, I think, as long as activists on the short side are continuing to publish really high quality, great research, it's of massive benefit, not just to ourselves, but to all the investors who read the work.
I want to pick up on something Freddy just said, though. I don't disagree with any of his points, but I think there's one other factor at play in terms of how much excitement there is around short activist publications. And back when I started doing this, it was a big deal, and to some extent, it's become much more mainstream. The nice thing is, as an activist short seller, that it's much more widely accepted part of the market. But the flip side of that is that, as Freddy pointed out, there's not as much buzz these days when somebody comes out and says, with a well-researched piece that presents a contrary viewpoint on a given company. But I think the other factor at play here is just, and this is something I've been talking about since probably either 2019 or 2018 maybe, is just how the further we've gotten from the financial crisis, the more anesthetized to risk investors have become. And COVID was actually, I think COVID took that to the next level, because initially people woke up and said, oh my God, risk, and things are selling off. But then the powers that be pumped everything back up and the system held. And so I think that when we're far away from risks that actually materialized, had long lasting deleterious impact on financial asset owners, I feel like, there's just less of a market for, on the long side, for hearing about problems that might exist in a company you're long. Whereas in 2011, 2012, the excesses of the previous bubble were fresh in everybody's mind, and people were worried about owning something that would go down the toilet. Now, I think that those concerns are just much less acutely felt anyway. So that's something else that I think is different, and that doesn't change until we truly have another crisis, which might be the crisis to end markets. at this point.
Well, some of the places where people have been going out and taking that risk, they're starting to feel the pain. So who knows, maybe the beginnings, at least on some of the SPAC crap that came out, some of the, total bullshit ESG companies that have come out that are taking advantage of those flows that Tariq Fancy was talking about. Those have, at least for now, are starting to feel some pain. Look, the goal of the channel overall is to educate people, to bring new ideas to the market, to bring great research, and to showcase all of the work that the activist short selling community is doing. But you also got to entertain people to keep them interested and to keep them coming back. And there were some pieces this year that came out that were just as well as being educational, that were just a lot of fun. I personally enjoyed so much getting to talk to Warren Irwin about his days with Bre-X and all of the slimy stuff that can happen in the natural resources industry.
Well, I focus on the resource industry because that inherently involves a lot of sketchy companies. But, obviously I had a front row seat for the whole Bre-X scam. I've had properties taken over by the government. I've had the KGB murdering people I know. I've had, stories of guys showing up dead, waking up dead one morning with their balls in their mouths. You name it. I've given money to auto parts companies where the companies have basically immediately stripped the money right out of the company and put it into a shell company to lease cars for the Toronto Italian mafia. So we've dealt with all sorts of things, whether it be the cartels in Mexico, the KGB, the IRA, the Italian mafia. I haven't dealt with the triads, but they all seem to get into the resource business somehow.
An incredible interview with Michael Woodford talking about his becoming the CEO of one of the largest Japanese companies, Olympus, and the shocks of understanding how Japanese corporate culture worked.
Because I got out the Factor magazine, the hard copy, and I showed it to Kikukawa, and this magazine was saying detailed allegations that the company had bought 3 Mickey Mouse businesses for $1 billion, not listed, no mark-to-market price, hardly any turnover. A food dish company, a face cream company. I mean, just crazy. And I said to Kikukawa-san, is it true? And to my shock, he said, some of it. And that's where it all started. And I got more and more agitated. And I said, I know you're very busy, but can I meet with Mori-san and go through this, go through these allegations? And I was the president, and Mori-san, in effect, worked for me. So he couldn't say no, but he got very agitated and his eyebrows started to flicker. And you know everything immediately. I don't know if you've ever had one of those situations, but I knew there and then this company was something terrible and bad was going on within that board. The relationship broke down as I started to write formal letters to him and a series of letters. He tried to tell me, it's not helpful to write these letters. I was told an independent committee had already looked at these issues. If you ever heard the term independent committee in Japan, take it for what it's worth, which is very little. And my life spiraled out of control from there onwards. And I suddenly found myself in a sort of John Grisham novel where I was the protagonist.
And then as well, you guys had the culmination of what had been a multi-year saga with the China Zhongwang aluminum fraud.
Probably the craziest story that we've ever been involved with has just come to a conclusion. This was the best research we had ever done. We were literally following containers from the factory to the port in China. Then we were tracking those containers from published information on manifests. We were then having investigators meet the containers in Vietnam, following the containers, the same containers with photos and video from the port in Vietnam to the processing facility in Vietnam.
So we covered not just the usual SAICs, credit reports, filings, and when we look through the wide range of customs and import-export data, China export data, U.S. import-export data, Mexico import-export data, going through Southeast Asia, pulling Hong Kong filings, Singapore filings.
Yeah, I mean, this project was real brain damage, not going to lie. Trying to keep a track of what was going on at what point was really tough. Trying to put that down on paper was incredibly challenging because these were some of the most complex flows of people, ownership, money, and goods that we probably have ever looked at.
Which, it's a complicated story taking place over multiple years, tons of different countries, different regulatory agencies, and we were able to put it all together for what was an incredible story that as well helped people understand this. When it comes down to just what you guys had fun with this year, the stories that you felt were just super entertaining, I'd love to get your take on that. Freddie, what was your favorite?
So I was sitting around one afternoon and I get a phone call for a friend and he goes, "You guys had Warren Irwin on?" And I said, look, truth be told, I don't know what's going out every day, week, month on Zer0es. And I said, yeah, is that like a good thing, a bad thing? Is Warren Irwin is a legend. So I sat down, watched the interview, and I think that's fitting. I don't know anyone who refers to their house by the name of the stock that bought it, but he has his Bre-X house. I subsequently learned he has a Bre-X number plate as well. And, we were able to have Zoom drinks with him after, which he didn't hold a lot back on the interview. He certainly held a lot less back in the Zoom drinks. So, for people who want to watch something with a, really colorful, just honest how it happened, rode a scam up, shorted it on the way down. This is the kind of real grimy detritus that exists within markets. I'd strongly recommend watching the Warren Irwin interview on Zer0es that you did, Max. I thought that really captured the essence of what it's like to be a Canadian stock jockey and resources investor.
Well, let's not forget there's the Bre-X house, which was the long side, and then there was the Bre-X car, which is the short side, which I think is fitting that, if you want a house, go long. If you want a car, go short. Carson, what about you? Was there anyone in particular that you just, couldn't pull yourself away from?
Yeah, to me, the most fun was, the way I experience joy, I most acutely experience it in the form of schadenfreude. So there was no moment that exceeded the Bill Huang blow up in terms of schadenfreude and entertainment value for me this past year. One of the things that was also unusual about GSX was almost every time we go out and call something a fraud, right? There is a cacophony of defenders on the other side, saying you misinterpret this, you got that wrong, you ignored this. But with GSX, it was weird. And usually these defenders, if it's a Chinese company, will come from China. But there just wasn't really an opposite side that I discerned being expressed. It's just such a clear fraud that I think your average Chinese retail investor agrees it's a fraud. But yet it tripled. What was happening? Well, looks like a lot of it was Bill Huang and his arch egos. Another was his former protege, Tao Li, and his firm, Tung Yue, and then maybe some others. And Tiger Global was disclosed long. I don't know if that was part of a box or what the deal was, but they tied up enough float. So if you look, the top shareholders outside of the management are all banks. So the banks were holding these positions on swap. And I think when you just add up the swaps, you have almost 70% of the float was choked. Look, having been on the wrong side of GSX, now GoTo, and knowing that despite the enormity or what we thought was the enormity of that market cap, eventually coming to accept the obvious that this thing was not trading the way that it should have been trading and, was like, I believe was seriously manipulated, then seeing this massive, family office that nobody had really ever heard of blow up. And that blow up also coincided with what seemed to be a somewhat normalization of the market. So it was, a couple of things happened, right? Like around the same time. So GameStop came off, somewhat, and in AMC, BlackBerry were coming down, and Huang blew up at that point. And so I think that there was, from that point forward, the market was, there were all of these opportunities for activist short sellers, as we talked about. But I think that Huang's blow up had something to do with that. I mean, that guy had $100 billion balance sheet and seems to, from what we understand, was just intent on creating squeezes. And so when you look at what was happening last year at the tail end, the most shorted index, I mean, those things ripped. It continued into January. And then when he blew up, it coincided with that trade going away. So I know that correlation is not causation, but I do think that there was some causality there.
Well, it brings up the idea of just the delayed vindication that often comes with activist short selling. One example of that was China Evergrande. Wasn't it Andrew Left who was, I think, actually banned from Hong Kong for years, as far back as 2015, for highlighting some of the issues now, which everybody is talking about.
I think he published in actually 2011 or 2012 on Evergrande. So it was very early, but the issues that he outlined obviously just grew more acute in the 10, 11 years since.
I'm sure there are many ideas which we discussed here which won't have their conclusions until a few years down the line. But that brings up some of the other topics. I mean, we didn't get into Cathie Wood at all. We didn't really talk too much about ARK and how that has been one of the big topics of 2021. As well as Cathie and ARK, are there any other things that, before we let everybody go here, that you think crystallized the year for Zer0es and for the markets in general?
Yeah, things have not continued to go particularly well for her. She continues to buy the less liquid stuff she owns more of as markets are going down, and appears to be selling the liquid stuff that's gone up. So I don't think it takes a genius to work out how that might end should she continue to do that and actually experience some outflows. It's certainly going to be an interesting year, despite her the other week saying that she sees a strong opportunity for her value stocks to continue to grow at 40% a year CAGR over the next 5 years. So I think in 2022, we'll get a taste whether that's likely to start kicking in next year, or if that's going to be a 2023 story for her.
It's just deep value. We haven't reached deep value yet. Once we get to the deep value territory, then we can expect that 40% CAGR. But that is a good way to look forward to 2022. Another topic that was huge in the markets was the China policy on delisting of their tech companies. I mean, we saw the Chinese tech ADRs and the NASDAQ were moving lockstep through 2020, 2021. We saw these two baskets really bifurcate for the first time, and it's looking like this is going to be a continued story in 2022. When you think about what's coming up next year for Zer0es, what's coming up next year for the market in general, what are the big themes that you think are going to be coming up?
I think next year, after Putin successfully invades Ukraine and then focuses his attention on the landing of the US, we'll be polishing up our Russian.
And don't forget, Germany will issue a very strongly worded statement condemning it.
And in addition to that, I think it's probably going to be the year that the NFT I've just bought sells for somewhere in the 8 to 9 figures. So a lot of exciting stuff going on in 2022.
Well, all kidding aside, don't forget it's an election year. It's a midterm, but one of the things I have talked about this year is really what if we had a situation in which there was a constitutional crisis over the 2024 election, and we're quite possibly headed in that direction. And I discussed that with Hugh Hendry. It's not just this interesting question of constitutional law and how would the Supreme Court rule. It could become, I think the 21st century version of the Civil War is really, it's really fiscal. effectively. And so this is one of the things that I really would wish people on both sides would think about, because there is, on the polls, you do hear people saying things like, oh, there's civil wars coming. And they seem pretty, they seem kind of accepting and sanguine about that. I mean, Rush Limbaugh, was, I think, basically, saying that would be a good thing. And it would be horrible. I mean, in a scenario in which outcomes like that are being contemplated, if not occurring, I mean, what are we looking at? I mean, I would think we'd be looking at a death spiral of the U.S. dollar, markets across the world grinding to a halt. But I mean, I'm curious, maybe you have a view on my thinking here as to if we had that sort of election outcome where, it's really perceived as just an overturning of the voters' will. And, I asked him, well, if we had a situation like that, and, there were real divisions over the winner of 2024 election, would the dollar depreciate? And he said, he asked, against what? Nobody's going to let their currency appreciate markedly against the dollar. But this is something that I don't really have a view as to how it'll play out in markets. But I think the political and policy dynamics of next year, those are going to be some really important crosswinds that everybody, long or short, is going to have to navigate.
Gentlemen, thank you so much. It's been an incredible year, and looking forward to more in the next year. Freddy, I sincerely hope you like the art of the NFT you bought, because that might be all you're left with.
I mean, you need something to hang on your ceiling behind you, man.
Yeah, you really do. Maybe look into some physical
What do you
as
mean?
well.
We've got the Muddy Waters over here, so we're gonna NFT that as well. It's go on NFTs for me.
Yeah, that would be. I would love to see what a line of Muddy Waters NFTs would be. We actually did have this year in the comments on some of the videos. I think, Carson, you pulled out a hard hat.
Right, like he was long this total fraud. Actually, I have some NQ memorabilia. This is a genuine NQ mobile hard hat. I got it from somebody who used to work there. They actually passed these out to everybody at one point.
Do you still have the gift you sent Jim Oberweis?
Well, no, that went to Jim Oberweis Jr., right? I think he basically stated, or at least implied, that Muddy Waters had, caused this to happen. Like, it was a great company, but for our report, the stock would not be in the gutter. I mean, it's since been delisted, of course.
Yeah, he's still waiting to be right.
People were interested in seeing the memorabilia you had collected over the years from your different shorts. So maybe that could be the Muddy Waters NFT line.
Yes, or we could do a Zer0es some Zer0es show next year that shows this off. We're putting the finishing touches on the gallery of corporate art in the coming weeks. So yeah, it should be ready for prime time by the end of January.
Wonderful to hear. Thanks, guys.
Thanks.
Thanks, Max.